The markets have just set up one of the largest FOMO traps I think I've ever seen, and I wouldn't be surprised in the slightest if in the shortened holiday trading week some accounts blow up, or if there are just some larger than expected losses out there. And that's exactly what we're going to help you avoid in today's episode of the Weekly Watchlist by building a logical game plan together that's focused on all of the relevant data points. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY monthly time frame, talking about candle structure and location now that the August bars have closed out. What do we see here? Certainly second bar in is looking like a red-bodied hammer candle, implying that the sellers did a great job of initializing some sell-side pressure. But look at the response from the buyers in that lower wick, picking up prices right off the lows of the monthly range. They were able to close prices in the upper third of the monthly range. Now, don't get me wrong, we do have a red-bodied bar, so we were unable to recapture the opening print, but it begs the question, why were the sellers, if they were truly going to be strong sellers, why were they unable to close prices towards the lows of the August range, or even just in the lower third overall? It just did not take place. So not really bearish from a candle structure perspective. If we think about location, it gets even better. Bar to bar count, lower high, as well as a lower low, but it's a substantial lower low because it's the lower low that breaks one time framing on the monthly in the upward direction. Every preceding monthly bar had a higher low compared to the previous month. So once again, it begs the question, if stronger sellers were finally making a stand in this market, why were they unable to close near the lows of the July bar, in the lower 50% of the July bar? As a matter of fact, if you split July in half, we've closed at or even slightly above the midpoint of the July bar. So once again, higher time frame structures and location do not speak to stronger sellers getting involved by any stretch of the imagination. Now, a lot of folks will refer to this bar as a hanging man candle, and that's fine. You can Google the definition. It's classically bearish, but here at the Trade Brigade, we treat every bar at face value. And the lower wick, once again, implies that as of right now, as of the close of the August bar, there was a substantial uptick there back above the midpoint of July's range. It's worth acknowledging that the upward momentum from back here has certainly come to an end. It's slowing down, but is it slowing down at a reasonable place? I would argue 100% yes. It's not that the sellers are overwhelmingly building momentum. It's just that the market's slowing down a little bit. Is that reasonable after the measured move of the inverted head and shoulders breakout? I would say absolutely from that perspective. We can even take it one step further and provide a little bit more context. If we zoom out and come in from the sickness low to the all-time high, we know that the 50 SMA and the 50% retracement both held. Were well back above the 38.2. If anything, this is looking much more so like bull flag breakout on the monthly time frame chart, searching for the equal high, which begs the next question. If this is going to turn into a double top, that's fine. Just remember that you need a lower low underneath your neckline before it's actually a double top, right? A double top would indicate some sort of trend reversal. The trend only reverses when we produce a lower low. From a sequencing perspective on the monthly, you have a low, you have a higher low, you would need some sort of lower low underneath the October lows from last year. And it doesn't look likely, especially noting that for the monthly to really break down, you would have to fail this break, retest, and possibility for a higher low if we got further selling in the first place, which once again, based on the structural close and the location close, doesn't really look all that likely that the neckline of that pattern is going to be back in play. But even if it were, it could produce a continued monthly higher low. Let's take a look at the weekly time frame chart. What do we see from this perspective? Same questions, candle structure and location as always. Candle structure is definitely more bullish than bearish. Solid green bodied bar closing right at the highs basically of last week's range. So that's bullish. And of course on the location front, bar to bar, higher low, as well as a higher high. Most importantly, it's an inside bar break in the upward direction, and we were fairly concerned about the inside bar because it represented the possibility of a head and shoulders rejecting around the same area as the possible left shoulder, right? So because we're above this box now, because we're above that breakout point or the rejection point from 2 weeks ago, I would say that that's much more bullish than bearish. Obviously, from the weekly perspective, we have now held from a trend sequence point of view, lows, higher lows, higher lows, higher lows. We remember that these were soft lows. Remember that we never actually flipped into a daily downtrend here. We certainly did, pulling back off of this higher high. So we've confirmed now that the 432 area is a set of weekly higher lows. And now that we're pushing away in the upward direction, the intended target would be the equal high closer to 460 or a higher high to continue the trend sequence and then afford your next set of weekly higher low pullbacks to unfold. So once again, nothing really bearish here from a trend point of view, a candle structure point of view, a location point of view. Walking forward into the current week's worth of trade, which is shortened, of course, today is a holiday. Any pullbacks that stay above this box, again, equal high is on the table. We'll change our tone and we'll become a little bit more neutral if we fall back into the box. And as we know, that level is 445. We'll talk more about it on the daily time frame chart in just a moment. What else can we see here? If we scrunch this chart up, the other thing to point out is if this is going to turn into a double top, so very similar to the monthly time frame chart, if it's going to turn into a double top, what do we have to break? We have to break the neckline. And where's that magic level? Right around 432. We know that 432, 430 is also important from a fib perspective, all-time high to the October low, 61.8. If we come in from here to the top, we've got the 38.2, but it gets better. We can come in from the low up to the high, and there is your 61.8. So really, on the higher time frame charts, there's no reason to be bearish as long as we're above 430 from that perspective right there. We can throw on the anchored view apps as well. And what you'll notice is the AI Mania anchored view app has resolved in the upward direction. Remember last week we were slightly skeptical with the close right on it, but I would say that this is resolution to the upside, being above all of our major anchored view apps, including the all-time high anchored view app does strike me as being more bullish than bearish. We can throw on our volume profile, and interestingly enough, with our volume profile, what you'll notice is that the magic zone, that 445, is the high volume node. And instead of acting as overhead supply, producing a rejection for what could have possibly been a head and shoulders, now we're above it. So that is demand underneath us. And if the buyers are going to step up on any pullbacks, it would make logical sense that seeing something like this would be completely fine, right? That would be healthy from a structural perspective. Once again, if we fall back underneath, we will become neutral and a little bit more bearish on the higher timeframes. If we're underneath 430, nothing about the structure or location would imply that that is a high probability into the shortened upcoming week. On the daily time frame chart, let's first evaluate the expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is 456.07, and that of course would be a higher high. If we're contained by the lower bound, the number is 446.29, and that of course would be a big time higher low. What I like most about the lower bound of this week's expected move is that it's above the neckline of the double bottom, which kicked off this trend reversal in the upward direction in the first place. We know that number is 445, as we were talking about on the weekly. So from a trend perspective, what's gone on here? Because it's fairly flip-floppy back and forth. We know that we had a high, and we know that we finally produced a daily lower high after flipping into an hourly counter trend move back here. But because we've taken out that lower high and we've produced a higher high from here to here, it's fair to say that the daily trend is now neutral, and it will confirm a new daily uptrend as soon as we can find a higher low above that level, ideally 445. Now, some folks would argue that you already have a daily higher low in place. I personally would like to see it after making a new higher high. So that's the trend on the verge of a new confirmed daily uptrend if we get a higher low over 445. From a pattern perspective, what do we see here? As we were talking about on the weekly time frame chart, if this was going to turn into a head and shoulders, we needed to break down through the neckline, simply did not take place. So it's not bearish from that perspective. If we come in like this, and we were talking about bear flag consolidation, you needed to stay underneath that daily 50 SMA, consolidate, and then break down. Obviously not the case either. The only pattern that's played out here is the double bottom on the daily, so it's not worth being overly bearish still. At best, you would be neutral, right? Maybe you don't want to be bullish yet, and that's fine, but you have to be neutral. You cannot be bearish on this daily time frame chart, considering everything that's unfolded here. Now, it's also worth pointing out, and this is really what I was referring to in the intro of today's video, that we've just seen a massive momentum move in the upward direction. We've seen range expansion in the upward direction. Remember that this was sort of contraction after we broke down. That was expansion from here, and then we were consolidating, right? Now we've expanded back in the upward direction. We've broken the double bottom neckline. We've gone to the origin of this breakdown from this move back here. So is it logical that on a shortened holiday trading week, we could see some slowdown after a move from expansion to a move for contraction? I certainly think that the answer is yes, and people who have FOMO, who have basically missed the short in here and missed the long over here, are going to be expecting that the market is going to move like a wildebeest, wild, back and forth, crazy ups, crazy downs. The market's going to be all over the place. I think that's a recipe for disaster, having the expectation that moves like this will continue. If you look at the expected move from last week, we were well outside of the expected move, something like a 2 or even 3 sigma move move with the gap up from the Friday session. So is it reasonable that the market slows down? I think the answer is yes, and you want to manage your expectations of that and not get hurt with overly aggressive expectations that, hey, we're going to break to a new weekly high. Hey, we're going to break all the way back on down to the local lows here at 430s. I just don't think that it's in the cards for the coming week's worth of trade for those reasons. We're at the origin, we're at the target, we just saw momentum, time for a little bit of contraction and let this market set up basically for the next move. I think that that's really the key watch for this shortened holiday trading week. It's also worth pointing out that on Thursday and Friday, both days we gapped up and the buy side momentum has slowed down. There was no follow through in the upward direction. There was no follow through in the upward direction. So it's not that sellers are getting overly aggressive. We saw that on the higher time frames. It's also not like we have big breakdowns back through this thin structure back here. So sellers aren't getting aggressive, but the buy side momentum is certainly slowing down and you need to be mindful of that. So on the daily time frame chart, before we get granular on the hourly, any consolidation up here builds out bull flag consolidation. Would love to see that straight through the end of this week. Then we have a range that we can trade against for early next week, right? I know that we're talking about weeks in advance here, but that would set up breaks to close the gap, higher lows above. Then we're looking for the higher highs. Or if we start to do something like this, we can trade through the thin structure and look for a deeper pullback to 445. Just as a line in the sand, if the market does break down in the shortened holiday upcoming week, we do something like this, you could trade for scalps in the downward direction here, but I would not overstay my welcome on the short side when and if we approach 445. To get more granular, let's take a look at the hourly time frame chart. Once again, you can see there's your double bottom. It's as clear as day. We're well above the neckline. We have thin structure on the breakout to sort of resolve that higher. But look at the Thursday and Friday activity. Again, gap up, a little bit of mild follow through, and then lower into the afternoon, gap up. It's lower, but then it stops right at this very mechanical level here at 450. So there's no evidence of stronger sellers getting involved, but I do think that you have longs late to the party who will turn into overhead supply if you break down underneath that 450 area. And once again, that trade setup looks something like this into the 445 if we're going to see a breakdown in the first place this week. I wouldn't be surprised if there are multiple failed attempts underneath and we just chop around and get really sideways through here. Again, hurting a lot of folks who have FOMO, looking for that next big breakdown, that next big breakout. I think managing expectations is really, really key after what we've seen here and after what we've seen over here. Before we talk about path, let's throw on the anchored view apps and see if they're confluence with any of the major levels that we are concerned with. I would say that the 445, it's there technically, but it's slightly higher. It's actually at the 50 SMA on the daily. It's at the lower bound of this week's expected move, closer to 446.25. We'll round off there. Then you can see the breakout anchored view app from in here is actually right at the 450. So once again, it's very difficult to be a bear in this market if we're above that, considering everybody who's gotten involved from the breakout move, the quote unquote average participant, right, is above water on their long position. So if we can break that, great. It's a move that looks something like this in the downward direction. What about the Fibonacci's coming in from the low in here up to the top? Your 38.2 for ideal or just acceptable bull flag consolidation is right at the confluence actually with your anchored view app. So again, something that does this, I would not overstay my welcome as we start approaching 446.25, 446 flat, somewhere in there. 445 is the major line in the sand, but slightly above that may provide some support based on the confluence that we're seeing right now. Once again, you can trade this as a scalp in the downward direction, but please do not overstay your welcome, and certainly looking for, if we just remove that now, let's come in actually one last Fibonacci perspective from the top down to the bottom. Notice that we are above our 61.8, so it's very difficult to be a short if we're above that 61.8. This sort of is all confluence now in the downward direction for this area. It's all making sense here as well. It's fairly straightforward what the path is, right? Any consolidation in here, neutral, bullish, over time, looking for the gap to close overhead. 453.50 closes 455.50. Anything beyond that, 457.75. If we break down, scalps only in the downward direction under 450, target 446 really, the anchored view apps, the Fibonacci's that we were just looking at, lower bound of this week's expected move, but line in the sand 445. When and if we get down here, the watch is for hammer candles, the watch is for intraday double bottoms, the watch is for intraday inverted head and shoulders. Any reversal pattern goes at 445 for a retest, because clearly you would be getting an hourly low, higher low, higher low, high, higher high, pullback, keeps your uptrend sequence in place, and would confirm the daily reversal as well. Let's take a look at some more supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, does this screen look bullish or does it look bearish? Obviously, it looks way more bullish than bearish. Net flows on the week up and over 500 million. We closed at 631 million. Tuesday's breakout was validated. Same thing with our advanced decline line. Here is the zero line. No time this week was spent underneath the zero line. Tuesday, again, validating the breakout in here. And the same thing with our cumulative tick validating the breakout on Tuesday. And even as we were getting some bearish activity intraday, at least on the Thursday and Friday sessions in here, very mild cumulative builds. I would just call those flat basically on the Thursday and Friday session. Volume inflows to the market on Friday, and both days the advanced decliner was over the zero line. So once again, it's not that we have strong sell side momentum, but the buy side momentum is slowing down, and it would be logical that a little bit of a pullback could take place here. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right hand corner. For the most part, let's check in on value areas and point of control. Where are they specifically in relationship to the Tuesday breakout? You can see that all of the value area and points of control are above the Tuesday point of control from in here, and even out to the Friday session as well, at least the point of control. The value area low starts to get a little bit mechanical at that same area. You can see the low of day is right to the point of control, and that's really going to be your threat for downside if the market's going to pull back. And that's fairly straightforward based on what we saw from the candle charts as well. Notice that all of the value after the breakout unfolds is mixed. Really, this is slightly overlapping to up, this is much more so sideways, and this is definitely overlapping to down into the Friday session. So everything about the value area here is much more indicative of sideways consolidation, not necessarily continuation in the upward direction. On the Friday session, notice that not a lot of buyers were willing to commit up at those highs, and instead value was slightly lower. So once again, lack of material excess on Friday's session. If we need to repair that, it's not technically a poor low, but there's not decent excess. You would want the auction to end in a more proper fashion. If we take out Friday's low right around 45.05, what would the pullback be? Well, we know that we're looking for the neckline of the double bottom, which is back here on the ES, closer to 44.70. And lo and behold, we talked about this on Wednesday. It's the beginning, that would be the defense as well, of the single prints from Tuesday's breakout, right? We know that we have single prints and thin structure underneath that. Holding up over the neckline would be defending that area of thin structure, keeping the buyers ultimately in control. When and if there is some sort of reversal off of that area, 44.70, you would watch for, can we make it back up into this area and possibly exceed it for continuation on the higher time frames like the weekly to the equal highs at 460 in our S&P. And in the ES, let's go back on over to the platform here, and I'll tell you what that number is. Let's maximize this quickly. I know we've got a lot of folks who have asked about the ES recently, so I want to give you those numbers that would be relevant to the ES analysis, right? The gap overhead that has the potential to close is over 45.70, closes up towards 45.92, and then beyond that, the highs from the move up here are closer to 46.25, right? So that would be your upside targets. And once again, on the ES candle chart, that would look something like that. There's your 44.75, 44.70, neckline of the double bottom, respect, come back in, then looking for follow through in the upward direction. Jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that the XLK heaviest weight risk on tech sector led the pack up 3.65%, followed by materials, energy, and consumer discretionary. Communications are also green on the week, just shy of 2%. At the bottom of the barrel, you see the utility sector, consumer staples, and healthcare. Something about all of these that is in common, of course, is that they are all D for defensive sectors. So the risk on cohort has certainly led the break in the upward direction, which does strike me as a confirming piece of evidence that, yes, we should respect this move in the upward direction. Let's take a look at these structural charts and evaluate what's going on. What did we know about the XLK? Ideally, into the end of the week, we were watching what was going to happen with the neckline, or just really the gap up high of Thursday from 2 weeks ago. Clearly, we continued to push away from it in the upward direction instead of failing back down underneath and building out something that looks like this. Even beyond that, as overhead supply, I mean, granted, we didn't get a lot of acceptance up there on Friday. You know, we poked above. It's not like we just purely rejected from the inverted hammer on the Thursday session, and that does strike me as more of a bullish indication than a bearish one. The fact that the sellers did not run away with it underneath the low of Thursday for a stronger pullback on the daily time frame chart. So once again, starting to become a little bit more constructive for a stronger reversal here on the higher time frames like the weekly. This is certainly looking a little bit more neutral, but on the daily, any higher low pullbacks now over 173.10, 173 flat are looking very good for your XLK. Being the heaviest weight risk on sector, that would be very constructive in the coming weeks worth of trade if we could pull back, respect that area, and then breach back above that 175.70. That would be the bull case, falling down underneath here, a little bit more neutral bearish on a lower high only under 170.25. Let's take a look at the XLB for materials. Big gap up on the Friday session led to a lot of the gains there, but from this choppy range, it's certainly trying to resolve in the upward direction. Again, look at this as a level. It's a really lightweight sector, so it's not going to be make or break, but just from an analysis perspective, right? The fact that we were able to clear this and close above that 83.60 does strike me as more bullish than bearish. Remember that we were coming from basically this look as a bear flag down on the lows, this big reversal back to, again, the beginnings of the breakdown, at least this most recent leg of the breakdown, and some does strike me as, once again, more of a bullish look than a bearish look. So it's difficult to be bearish when the sectors are looking fairly decent like this. XLE energy sector, this is a lighter weight sector, right? And as we know, a little bit more inflationary. This is the talk of the town. Maybe we'll look at oil today as well, CL, as we move through the analysis. But this is a bullish break. Upward pressure is upward pressure. If the XLK was at the bottom of the barrel, this would be a concerning look. But because the XLK led, I have to say it's not overly concerning yet that energy is kind of, making a move in the upward direction with the broad market supporting it during this reversal. If this does pull back because it's a lightweight sector, again, it's not the end of the world. And if anything, it helps the inflation case, that inflation is going to come down. So energy doesn't really strike me as something that can hurt the broad market in a major way based on its position right now. If we look at the XLY, again, what was the concern? That this, as overhead supply, was going to cause a stronger rejection. And you can see, again, on Thursday, inverted hammer. Friday, we take out the low after gapping up and over it. Don't get me wrong, it's a bearish engulfer, absolutely. But is there not now the opportunity for a higher low over the neckline of the double bottom at 167.25? I'm not really seeing the overly bearish argument here yet until we can get back down underneath that level. As of right now, you got lows and the opportunity for a higher low set to be built out over that neckline. If we fail it, once again, we'll change our tone. But as of right now, it looks likely that a little bit of pullback here, which would coincide nicely with basically what we want out of the SPY, would be reasonable. And then we'll watch for that sort of look to see if we can get that reversal, 167.25, right? That's the number to watch. If it just continues in the upward direction, chopping through this range has to be bullish to neutral for our broad market, just positionally, right? Being so close to that pivot high. Let's take a look at the XLC. What's going on over here? Once again, where's the neckline of your double bottom? This one had the most work to do considering the hammer candle from early, or I should say late, 2 weeks ago, right? The Friday of 2 weeks ago. And currently we're back above. We're back, inside of what could have acted as overhead supply. Your Tuesday breakout firmly gets through that, right? Right to this area in here. It's very difficult to say anything bearish about the XLC in its current position, right? If the stronger head and shoulders argument was going to be made, you wanted to see a breakdown, a flush underneath this level in here. Or even if this was your head and shoulders, right? Then the neckline would look something like a trend line underneath in here. Just simply not the case. It's very difficult to be bearish once again with the charts that look like this. You want to see the hold ideally in the XLC over 66.75. Friday's candle is not rainbows and butterflies. It doesn't really look beautiful, but if we can test underneath and then come back above and close out an early week hammer candle, maybe that's enough to keep us in this range, which would be neutral for the broad market, which is exactly what we want. Neutral consolidation or a reasonable pullback, right? Let's take a look at the XLF. What's going on over here in the XLF? Certainly worth pointing out that we did rotate away from this as a weekly higher low. We're not out of the woods yet. A lot of work to do here still in the XLF financials at 34.75. A lot of work to do. So this one falls more so into the neutral category because it's still underneath its possible overhead supply, but I do like the defense of the weekly higher low here at 33.65. So neutral until proven otherwise. Ideally on the daily time frame chart, we do not make a new lower low underneath 34.20, right? You get something that goes like this, and we start the staircase in the upward direction. That would be bullish for the broad market. Falling underneath, I would have to be, okay, looks like a threat, right? You get a weekly lower high, and then you get the equal low reattempt. That would look like a threat in the downward direction, which would not be helpful for the bull case in the broad market. Here's the industrial sector. Once again, not rejecting. Oops, sorry about the zoom there, folks. Not rejecting that overhead supply. As a matter of fact, getting price acceptance on the Wednesday, Thursday, and Friday session over 108.15. Very difficult to be bearish on that. Here's real estate, lightweight sector sideways towards the top of this as an overall range, but still underneath the prior pivot top. Obviously, we'll have a lot to do with rates. Utilities, right? This is where actually a bullish argument could be made for the broad market, right? Utilities is a lightweight risk-off sector. Is it oversold down here? Possibly. If it gets some snapback, if it moves in the upward direction as the XLK or the heavyweight risk-on sectors pull back or consolidate, what will that do for the broad market? Let's put the pieces of the puzzle together, right? If this is picking up the slack, it's going to keep your broad market consolidating into a daily bull flag instead of some sort of larger breakdown. So the fact that the lightweight risk-off sectors are oversold, utilities, look at consumer staples as well, right? Breaking down from this H pattern right at the equal low. If there's some snapback in these lighter weight sectors, that'll help keep the rotation alive and actually bullish for the broad market as possibly the XLK, XLY, XLC, XLF cool off a little bit, right? Especially the XLK, I would argue, right? If that cools off, you want to see these lighter weight sectors picking up the slack. Last but certainly not least, healthcare sector, same concept, right? Here it is in a balance range. Don't get me wrong, we are coming into the lows after a lower high, so the threat is for downside, but as long as the other sectors can pick up the slack, if the XLK remains stable, if the XLY, XLC remains stable, that's fine. We do know that this is the second heaviest weighted sector, so if there's a stronger pullback out of the XLK, if there's a stronger pullback out of the XLY, XLC, we'll be a little bit more concerned if the XLV is breaking down underneath 132.65. But once again, based on the rotation sort of theory, if this finds support at the bottom end of the range while the other things are consolidating, that would help keep your broad market a little bit more neutral. Let's take a look at the ratio grid. If you're not familiar with how to set this screen up, check out the video tutorial in the top right-hand corner. But for the most part, this is continuing to look like the revival of the risk on look. Notice that the XLK has made a substantial move in the ratio in the upward direction, recapturing a now flat 50 SMA and looking to see if we can poke up here for the equal highs, if not higher highs over time. Coming from this low, this micro trend in here is definitely more bullish than bearish. XLV, D for defensive, rolling over look here. That would be an indication that risk off is not becoming the predominant theory out there in the market. XLF, it's got some work to do. We talked about that on the structural chart. This strikes me as being a little bit more neutral as opposed to bearish right now. And the XLY, we do have to concede this point. It doesn't look great. There's still the opportunity for a daily lower high, and we know that we have produced a lower low in here. The only thing going for it right now is that if you want to count this as a double bottom, we're still technically over the neckline. It's got to sort of improve, show improve early on in the coming weeks worth of trade and get up and over what is now a slightly descending or even flattish 50 SMA. Are we seeing the risk off sectors really outperform? These speak for themselves. The answer is no. The answer is no. Energy, a little bit of a threat, right? Little bit of a threat only from the risk on, risk off perspective that, hey, inflation resurgence, right? But from the structural chart perspective, upward pressure, and real estate, absolutely not either. It's a good thing we were fairly patient over on our specialized ratios. We talked about this on Wednesday. XLK versus the XLU, risk on versus risk off. What would this move in the upward direction indicate? That the risk on look is certainly more strong than the risk off look. If it was a risk off rotation, this chart would have broken down from this as a sort of ugly head and shoulders or even just upper consolidation that led to distribution and then a move in the downward direction. This speaks to increased bullish odds for our broad market. Let's take a look at the XLY over the XLP. So we've got consumer discretionary versus staples, risk on versus risk off again. And there you go. We've broken up and over those highs. We're not out of the woods yet. We did not exceed and make a new higher high, but there's no longer really the threat of this as a head and shoulder. So I'm liking that also from a risk on perspective. What about our good friend, the dollar? As we talked about on Wednesday, if this is going to turn into an equal high rejection and a double top breakdown, we would need to violate the neckline, which currently sits around 103, and we know that to be the case based on all of the other patterns we've discussed in today's video. But breaking down underneath 103 bodes well for the bull thesis in equities down below. If we continue to consolidate in this range, we'll leave it open to consolidation in the bull flag range for our S&P, and if we take out the 104.50 and move towards the top of the range, which is not totally off the table after a look below and fail in the grander scheme of things from this range back here, that would of course mean a deeper pullback for equities. So watching the key levels in the dollar at 104.50 and 103. Do we get the double top and reject in the downward direction that would support the bull case for equities, or a breakout here, which is not totally unreasonable considering the most recent momentum, considering the look below and fail? If we get that breakout, expect that deeper pullback to retest the neckline of the double bottom at minimum in your S&P. What does the gold contract have to say about this? If we fire up the GCs, what do we see over here? Taking a closer look, it seems reasonable that the gold contract could pull back a little bit further. The reason I would say that is because on the Friday session, we did produce a higher high, but also a lower low. So the lack of follow through in the upward direction and closing week at the lows and today's shortened session at the lows would seem likely that we could come in for a retest of 1950, and that would be your inflection point. If we can find a higher low there, turn prior resistance into newfound support, it probably speaks to the dollar staying in the consolidation range or even rejecting the double top. If gold breaks down underneath 1950, I would look for the deeper pullback in equities and the stronger move higher over the 104.50 over in the dollar. What about the TNX? What's going on with the 10-year interest rate? Very interesting stuff over here from a technical point of view. We know that we've pulled back from a higher high, and as of right now, we're trying to build out a higher low with the engulfer on the Friday session, moving higher after the jobs report. So as long as we're above 4%, 40 on the TNX, it's hard to say that there's a stronger trend reversal. What you would want to see if you want to be bullish on the broad market down below because of the relief of pressure in the tech sector is you would want some sort of head and shoulders to find a daily lower high and then threaten the move back down underneath 4% in the 10-year yield. As of right now, I think that's a little bit hopeful, and really sideways consolidation strikes me as fine, or even if we break out here, that would put some downward pressure on equities. Exceeding this most recent high is also exceeding the high from late last year, right, where we know this is kind of what kicked off the bottom in equities, October, and there's your October low, right? So exceeding that in the upward direction gets a little bit sketchy from the tech perspective, putting more downward pressure on the tech cohort, which in theory provides drag and headwind for equities down below. Watching that TNX around 43.33 and 4%. Any consolidation here is okay. Anything that continues to break out, not so much. Let's take a look at the TNX and see what's going on with our 2-year, just to get a sense for how we might interpret the Fed tracker tool in just a second. The sort of contract roll is throwing us off a little bit here, but you can see that we have found an equal low. It's probably even a little bit of a higher low or equal with this one in the past if you account for the contract change. So we've pulled back and certainly back inside of the range. So more so a pause, but if we find support off of this area around this 102 and move in the upward direction, as a matter of fact, let's just take a look at, let's go, what would the ticker be? DG, let's try S2. And then if we throw a fret on there, does that work? Yes, it does. Beautiful. Thing of beauty, right? Let's throw this to a line chart real quick. And this would just be the 2-year yield plotted, right? So if you get up and over this support trend line and break out of this as an ascending triangle, the 10-year probably follows on its heels, right? So the Fed tracker tool right now is not pricing in a secondary hike, but if inflation rears its ugly head, because we know that we got an okay, we'll call it, print for July, if the next one in September that comes out, CPI prints, PPI prints, PCE prints come out bad, you better believe that this ascending triangle is likely to break out, which would imply maybe a Fed rate hike in the November timeframe. Speaking of, let's just go over there now. So here's the prolonged pause, which makes total sense compared to what we just analyzed from the 2-year yields. And this is different from what we know at the end of Jackson Hole. If we go to the compare tab and we're looking at the November timeframe and you look at the probabilities, you'll remember that we had increased odds of a hike and decreased odds of a pause, and that went back the other way. Decreased odds of a hike, increased odds of a pause, after we really got the first JOLTS report on Tuesday of last week. If we look at that fundamental calendar, what you'll remember is that JOLTS and really all of the employment data came in softer than the expectations. GDP was also softer than the expectations, and the wild card, the PCE, inflation index basically came in right in line with expectations, 0.2 on the month-over-month core. We know that the year-over-year annualized is at 3.3, but I want to bring up an important concept here and why the pause still makes sense based on what Powell has said. One of the key components that he mentioned when inflation was first starting to come down was that 2 months does not make a trend. So everybody worried about inflation surging back in the upward direction. I think Jerome Powell is looking at this and saying, great, the base effects are no longer here. It makes sense that we're higher. And once again, just like 2 months don't make a trend in the downward direction, 2 months don't make a trend in the upward direction. So it's making more sense to me that Powell would pause and not go for that hike just because inflation ticked higher by 0.3% using his own logic. Now, there's a couple of other charts that I want to show you today. And big shout out to Michael McDonough over here on Twitter. Great follow if you're looking for some Bloomberg charts. But the NFP with contributions, if we take a look here, has actually moved in the upward direction. So although the numbers came in underneath expectations, the NFP trend is actually in the upward direction. And if you take the difference, or the rate of change basically, in the month-over-month read, if we went from 157, which was the prior revision, to 187, that's a 19.1% increase on the month-over-month. Now, the next thing that everybody was concerned about was the unemployment rate, which did in fact tick higher. So here's the breakdown of the unemployment rate. And we basically went from a 3.5 to a 3.8. And this, it's really down here, is your 3.8 on the non-discouraged and the non-part-time. But regardless, what the increase is from 3.5 to 3.8 is 8.5%. So there's more job creation on the month-over-month than there is an uptick in the unemployment rate. So again, 19.1 increase in jobs versus 8.5 increase in the unemployment rate. So rate of change is always an important metric to track, and that's one of the reasons why I believe the market did not fall off aggressively, seeing this uptick in the unemployment rate. And what about the risk appetite? TLT ratioed to the S&P continues to break on down after building a little bit of a base. If there was ever going to be a shot at breaking that resistance trendline and flipping to more of a flight to safety style look, you would have thought that it was going to happen sooner rather than later, but into the end of the week, if we just zoom in on this chart, clear breakdown, and obviously equities were not down nearly as much, causing a downtick in the ratio. No flight to safety. This would speak to solid risk appetite for equities down below. We could take it one step further and look at short-dated bonds in relationship to one another, and I'm not totally convinced that we're all the way there yet. Remember that we wanted lower lows underneath these prior pivots, and you'll see as of the Friday session, there was a slight uptick, and uptick. You basically want a lower high now to confirm somewhere underneath the prior pivot top. If that takes place and then we get the lower low, that would speak to restored faith basically and more confidence on the longer time horizon, and basically speak to good risk appetite for equities down below. We could also look at credit spreads, and these are continuing to move in the right direction, remembering that we basically wanted to see a rollover back underneath the 50 SMA. So once again, a little bit of a mild uptick here and here into the end of the week, but strong opportunity for a lower high, strong opportunity for a lower high. As long as they remain underneath and do not exceed these prior highs, we are good to go. And once again, multiple viewpoints of risk appetite do speak to favorable risk appetite, not sort of flight to safety style moves. Let's take a look at the HYG in isolation. Stronger pullback on the Friday session, clearly from here down versus what we got in equities. So do you want to be a new money long up here at the top when HYG is pulling back like that? Maybe not. It would speak to better odds of possibly being patient, looking for the pullback buy over the neckline of the double bottom. That would be the equivalent of this on your HYG, which currently looks to be respected. So that would stack up as a bullish data point, but being a little bit patient to get there in the first place. And then what about the digital gold? It pretty much gave up that rally that we experienced off of the lows in here, but it's not breaking down aggressively. We'll keep an eye on it through the thin structure back here. If it continues to hold up and consolidate, that would be a bullish implication for broad markets. If it does break down, we'll take it as a small grain of salt, only one minor data point in the big web of analysis that we spin. Remember that as the pullback was unfolding, we were slightly concerned with market breadth getting back down underneath the zero line, but we have recaptured the zero line, and that certainly does strike me as a positive indication. Remember that when it comes to new highs versus lows, it's not about how high you go, it's about how low you don't go. We want to avoid a look like what we saw in 2022. Ideally, yes, of course, we want this to make some better impressions up around 400, but as long as we can avoid this, it would be difficult for the market to fall off of a cliff. Let's take a look at the SPX A200R stocks trading above the 200 SMA in the S&P 500, defending the 50% mark. So that does strike me as a bullish phenomenon, continuing to stack higher lows in this overall sequence. It would be better to push away from that in the upward direction a little bit more firmly, but the defense of the 50% does strike me as a constructive look. The biggest concern is in the SPX A50R, stocks trading above the 50 simple moving average in the S&P 500, and this is still underneath the 50% mark. So I would hate to see some sort of equal high produced up here with weaker breadth out of the SPX A50R. This really wants to recapture the 50% mark and start making strides in the upward direction. If we make an equal high out of the SPX equities down below, and this makes a lower high reversing underneath 50%, that would be a pretty big red flag that I would keep as a solid data point in the back of my mind as we're looking for long-sided opportunities. Really want the recapture of the 50% mark over here. Let's take a look at the RSP equal weight S&P 500. I do like this. This is a bit more constructive, finding that higher low over 150, or attempting to get some price acceptance over 150. Remember that that's the equivalent of the 445 level over on your S&P weighted equities. Remember that your neckline of this as a double bottom was far underneath, so it had more work to do to recapture that level. And once again, this strength there and the move over 150 does strike me as a solid indication. So far, the SPX A50R is the biggest issue from a breadth perspective. Same thing over on the Dow. I'm liking how these are moving in sync, and both of them are cooperating nicely in the upward direction, trying to hold on to these key areas of support. VIX volatility continues to collapse, sub 15, and for all the folks who say that the VIX is broken, I think that it was pretty valuable in terms of its indications for the market. As the market was breaking down, the VIX was elevated. As the market started to rally, the VIX was in decay. And even if you don't like this, the precursor to the VIX, as we know, is the VVIX, and this really told the story. As soon as this failed breakout over the top of the range happened in here, and we know that this Friday close from last week really was the writing on the wall for the VIX itself to continue in the downward direction. Now, we are approaching the complacency zone, but just remember that you need a couple of days, a couple of weeks of sideways consolidation here near that 75 level before it's really more so in effect. I would say that this is not a big threat as of right now now, especially if we pair it with volatility futures over here, moving into a stronger contango and a stronger contango in the 9 versus 30 day. And we also know that we've broken our support trend line here. We haven't reset all the way back down towards 7.5, so I don't entirely know what to make of that over here. But on the day by day, volatility is continuing to degrade instead of increase like it was doing in this prior trend. So overall, volatility conditions speak to a more bullish market as opposed to a bearish market. Moving along to the QQQ monthly time frame chart, same old song and dance. Aerosmith is on repeat apparently. Hammer candle, hanging man, whatever you want to call it. We take it at face value. The lower wick taking out the previous month's low, completely failing to materialize underneath and then closing back above the midpoint of July's range, does strike me as bullish for all of the same reasons as we discussed over on the S&P. Is it worth pointing out that sure, there's a change in tone, there's some slowdown in the straight up momentum to a little bit more of a sideways consolidation type look? Absolutely. But it does not mean that the QQQ is ready to fall off of a cliff just because we have a quote hanging man at the top of this range. It would really require a stronger breakdown on the monthly chart underneath this area down here, 320. I know I hate to be that guy, but a monthly higher low could technically be produced here for a longer time frame cup and handle to be established and then a breakout into the future. We're talking about months, maybe even years in the making, but that's kind of the higher time frame look from a technical perspective. We could do the same thing with our Fibonacci's. We remember that the rally is much more pronounced off of the sickness lows to the highs. We did hold the 61.8. We're well back above the 38.2. The more time we spend up here, the more likely it is that we do make the equal high. And once again, if a deeper pullback does unfold, there's your 320 from a Fibonacci perspective as well, finding a higher low above also. This as a sloppy, but technically there, inverted head and shoulders. If it's going to be a double top, you know the drill. It's got to take out the neckline. Obviously, to get there, that would mean a substantial move in the downward direction in the first place, but please don't call it a double top. Let's take a look at the weekly time frame chart, see what else is going on from this perspective. Same concepts as the SPY, closing back above the top of this as a prior range. Equal high would be the intended target. Closer to 385, 387. We'll see that on the daily in just a moment. Pullbacks that hold above that level, the top of the range. I'll give you the number actually right now, 372. That's the neckline basically of the double bottom. Over 372, looking constructive on the weekly for the equal high, if not higher high, to continue the overall uptrend sequence that we are sitting in. We've talked about all the same concepts with our Fibonacci's from here to here, and then we can come in from the low of here to here, and then we can come in from the AI Mania breakout from here to here, and everything is confluence around that 350 mark. There's really no reason on the higher time frames to be bearish on the QQQ unless we're underneath 350. If it turns into a double top, maybe underneath 360, the soft set of lows kicks things off, but a lot of confluence here around that 350 zone. We can throw on the Fibonacci, or excuse me, anchored VWAPs on the weekly time frame chart. We've continued to resolve all of them in the upward direction, pushing away from the AI Mania anchored VWAP higher. Again, everything here very similar to our S&P. Same comment, even from a high volume node perspective. There it is. We've pushed above it. If we pull back, 372 support instead of overhead supply. Now, the next major overhead high volume node is the equal high, as we were just talking about, closer to 385. Let's take a look at our daily time frame chart and see what's going on from that perspective here in the QQQ. What's going on? Taking a closer look, let's get rid of that Fibonacci. I don't necessarily think that we need the fibs there, but if we're looking at the QQQ daily, here's the expected move. Obviously, higher high and higher low, once again respecting that key zone, 372, the neckline of this as a double bottom pattern, also prior resistance from off in the past, and also our daily 50 SMA. Lots of confluence at 372. That is your key pullback zone. Once again, well extended outside of last week's expected move. Expansion oftentimes leads to contraction. We did close the overhead gap and we've pulled back off of that area. Once again, a gap up that failed on Friday's session. It didn't fail in the sense that stronger sellers really got involved, but there was no gap and go. The upside momentum is dying out just a little bit. Ideally on the daily time frame chart, you get some sort of flag consolidation over 375.50 and break in the upward direction over time to achieve those equal high targets from the weekly at 384.50 and then 387.25 is the top from back down over here. From a trend perspective, same comments, right? There's your low, there's your last lower high from here to here. Obviously, we've got the higher high, higher low pullback confirms a new daily uptrend anywhere above 372. Let's take a look at the hourly time frame chart. Just to get a little bit more granular with our levels, what do we see over on the hourly? Again, uptrend firmly in place. Maybe if this is going to turn into a head and shoulders, that's fine. It's really not an aggressive head and shoulders because we know that once again, 372 is the area where we're going to look for support for a higher low pullback on the higher time frame. So what would that neckline be? Once again, 375.50. Breakdowns intraday that produce a lower high. This is a scalp short through that area. And then the same concepts apply looking for the higher low. We're going to look for hammers. We're going to look for double bottoms. We're going to look for inverted head and shoulders. Any reversal pattern really goes at 372. That would be a stronger buy point with tighter risk reward for a rotation back in the upward direction, trying to achieve the equal high here. And then the 385 levels that we were just talking about on the daily time frame chart. If we do fall underneath 372, and this would be the equivalent and the same analysis, same comment for SPY underneath 445, this becomes much more neutral and choppy. Simply put, on the daily chart, right, you're really getting this push and pull. You're technically in a weekly uptrend holding the higher low set over here. But if you do something like this, do you jeopardize it with now a weekly lower high? That certainly does strike me as a possibility, but one step at a time. Once again, nothing about this structure over here is overly indicative that stronger sellers are getting involved just yet. Let's take a look at the anchored view apps intraday to see if they're providing confluence, and lo and behold, of course they are. I wouldn't lead you astray. 375.50. Again, it's your neckline. If this is a head and shoulders, it's also the breakdown of the anchored view app. Great lower high. What do you target? 372. Oh, lo and behold, there are all the anchored view apps over time. Key area of support. So everything is making sense from that perspective. Any consolidation that breaks in the upward direction, you've got to get a higher low over the initial beginning of the gap at 379.25. That would be a little bit more constructive because it was a poor high on the Thursday session. Something that does this, maybe you can see some legs in the upward direction, but just remember where you are at in the overall trend sequence. Let's take a look at the market internals for the NASDAQ side of things. Again, very strong inflows throughout the duration of the week. We're typically looking at 600, positive or negative. We had 800 million on the close of Friday. All of the advanced decline line activity is above the zero line. All of the cumulative ticks are positive, even more so a positive build on the Friday session as the market was pulling back. Once again, stronger momentum sellers are not getting involved, but we are seeing a slowdown in terms of bull side or buy side, upside momentum into the end of this week. Is a pullback reasonable? I would say absolutely at this point in time. Last look is the market profile for the NQ side of things and similar comments. Obviously, there's your value area from the Wednesday session, Thursday, and Friday. Value is starting to become overlapping to slightly down from Thursday to Friday's perspective. Point of control is lower in the profile on Friday. So it does seem reasonable that if we take out Friday's low, just like over in the S&P, you can start to look for your breakdown. Where would the single prints and the retracement bring you? Around 15.3. 15.3 in your NQ would be the beginning of the first string of single prints. We know that there is a double set over here, but that would be the good first target to watch for a breakdown. It's also confluence with the value area low from the Tuesday breakout, so I'm really liking that as a downside target. 15.3 if we start to see a more aggressive pullback. And once again, on your QQQ, it would be the equivalent basically of the top of that of the double bottom neckline. At a loss for words there. In the upward direction, why were we saying it's a stronger look over the Thursday highs? This is why right here, because you have single prints from the A period on the Friday gap up. So something that does move in the upward direction there is looking fairly good over 15.6. 15.6 higher lows unlock the thin structure to the upside. Single prints, same concept, and then we can look for that rotation higher. IWM monthly time frame chart. What do we see here from a candle structure perspective? This one is certainly different, less so a hammer type look and more so a red-bodied bar with a little bit of a lower wick on it. And from a location point of view, it's an inside bar. It is totally inside of the previous month's range. It did not take out and make a lower low. And if we think about the grander scheme of the location here, this is looking much more so like a failed breakout attempt in the upward direction. And now we're back inside of the monthly range. So if we break down underneath the two monthly equal lows, I'll give you that number right now, 180 roughly. If we break down under 180, the rotation to the bottom of the range on the monthly would be the more acceptable outcome. That, of course, would be bearish, and that would spell trouble for the broad market, seeing the IWM trade back down towards that 164 level. Now, we are holding on to the monthly 50 SMA, and maybe the lower wick represents, okay, there's some sort of buying pressure. Maybe it's going to try to continue to build out a monthly set of higher lows, but I really would have loved to see, after a monthly close outside of this range in July, a little bit of follow-through, or at least another close outside of range in the month of August. So a little bit different from that perspective over in the IWM. The other thing, of course, is if we come in with the Fibonacci's from the sickness low to the all-time high, you'll recall that this level is the 38.2. You really got to get more price acceptance up and over that if we're going to be more constructive on small caps, which, as we know, can act as a risk-on, risk-off proxy for the broad market. You really got to resolve that 188 level in the upward direction. So speaking of, let's take a look at these smaller time frames like the weekly. What's going on over here? Weekly look is definitely constructive, right? Hammer candle off of the weekly 50 SMA and also near the bottom of this range. We broke the top of the hammer and then did make a move in the upward direction. We also took out the top of the prior range over here, so not as concerned with the opportunity for a head and shoulders. Don't get me wrong, you can still get a weekly weekly lower high in here, but it's not as pronounced of an opportunity, staying underneath that area of resistance. If we do make the full rotation, it's towards the top of the range, which is closer to 197 at this point in time, and that, of course, would be bullish into this upcoming week, getting follow-through from the reversal off of the weekly set of higher lows back up to the equal high. 197 would be the weekly target. Let's take a look at our anchored VWAPs, what's going on from that perspective. We did hold on to the October low anchored VWAP. We resolved this one back in the upward direction, and we even recaptured the all-time high anchored VWAP, but just by a slim margin. Remember that if this was going to be more constructive, you really wanted to see something that looked like that. That would have produced your break and retest look on the monthly time frame chart. So a bit more neutral out of the IWM for all of these reasons, and we can even throw on the volume profile. And just as a reminder, right, this high volume node, it's technically resolved in the upward direction. The next target would be the top of the range, closer to that 197 as your next major overhead high volume node. If we break down, you've got strong volume support, which is one of the reasons why I wouldn't be overly aggressive looking for something like a monthly bear flag breakdown underneath the bottom of the range in here. That just really wouldn't make sense based on the volume perspective and all of the interactions for these equal, if not higher lows into the more recent time frame. The IWM must get some price acceptance over 200 to be more constructive in the upward direction, 197 to be more constructive and approach our next overhead high volume node 225 would be that target here on the higher time frame. Let's go to the daily and let's keep it brief over here. Actually, we'll do it this way. That way our levels are intact. Beautiful, good to go. What do we see over here? Just like everything else, is it reasonable that the IWM could consolidate after seeing a big move outside of the expected move from last week? Absolutely. We also reclaimed this area. We just saw that on the weekly time frame chart, right? That's over 188. Ideally, higher low pullbacks stay above that, and we don't get anywhere near the neckline of this as a double bottom, right? So the most constructive look for the IWM is respecting the lower bound of this week's expected move, 188.25 as your key area of support. Inverted hammer on the Friday session might imply that maybe underneath Friday's low, you get that pullback in the first place. But notice that on Thursday, we technically also had an inverted hammer. That would be a bearish pattern. And Friday, the gap up actually materializes in a higher close instead of a weaker close. So IWM's trying to show and prove with a little bit of strength here. And on the blatant recapture of 188, no rejection underneath for the larger time frame head and shoulders, right? We just talked about this on the weekly, right? Because that's off the table, got to give it a little bit of the benefit of the doubt as long as we're over that 188 level. Let's take a look at the hourly time frame chart, and you can clearly see the stair steps building, right? 1, 2, 3, 4, maybe even 5 higher lows in a row here, continuing to get highs, higher highs, higher highs along the entire way. So pulling back off of a higher high in this hourly trend sequence, once again, everything is well and dandy over 188.25. What did the anchored VWAPs have to say about this one intraday? Let's take a look. And it looks like we've got nothing. That's because it's the weekly set, I just realized. Let's take a look at this. There we go. And those are all the major inflection points. And even if you want to add on some of the breakout lows from in here, let's just go to the other one. So first and foremost, right, we're above all of the anchored VWAPs from all of the bearish activity. That's the first takeaway there. If we come on over to this set over here, there is from your lows, we're above all of those as well. So any higher lows, these will slowly start to coincide over time this week with that 188.25. That's your bullish situation for the IWM. If we fall underneath, I would be a little bit more reserved in the broad market and probably look for maybe a test of the necklines, if not a violation of the necklines over in the double bottoms if IWM cannot hold on to 188. Straight up continuation, next overhead target 193.25. Wouldn't be banking on that with the extension and with the follow through even from the Friday session. It's not a short, but it's also not a long up here. I would wait for the better entry on a pullback that respects 188. Let's take a look at the internals for the Russell side of things. And again, strong inflows on the Friday session when we actually saw that follow through the gap and go, a little bit of a move higher, right? Strong inflows, strong advanced decline line, decent cumulative build on the tick. Not the greatest, because obviously into the afternoon we faded a little bit there, but it definitely is more positive than negative. So overall, the consolidation and the move is validated to the upside instead of being divergent and sort of skeptical in the upward direction. Here is the market profile, and there is your consolidation up towards the top. Obviously, on today's shortened holiday session, it looks like we interacted with the poor low. We're going to treat that as being not fully resolved. So if we take out Friday's low, it's an inverted hammer low, it would make the most sense to me that it is possible for the small caps to see a breakdown. And once again, what would the target be? I would start to look for some of the breakout area back here. That would be the better target for the Russell futures, right? And that's going to be at 1884. 1884 is your number out of the Russell futures. If we do consolidate up here towards the highs, hanging on to this level right here at 1900 keeps us in ideal bullish consolidation. Under 1900, 1884, as we just discussed. If you've made it to this point in the show, I want to take this time to say thank you. I appreciate you coming out. More importantly, I hope you had a refreshing long weekend, a nice Labor Day weekend. I certainly did. Ready to hit it hard, get back to business for tomorrow morning's open. So here we go. Apple is up first on the core list of companies. Daily inverted head and shoulders has certainly broken out. We've made a substantial move in the upward direction, and we've closed most of the overhead gap from the last earnings cycle. So this is a patience play, waiting for the next setup here. It's very difficult to be a new money long after the range has expanded so far. You want to wait for some sort of contraction. Now, if we do see a deeper pullback, 185 is a top watch, and anything deeper than that, it's still reasonable that you could find a daily higher low above 181.50. If we take a look at the hourly time frame chart, once again, it's probably a better trade to wait for the thin structure breakdown under 185. That would be your scalp short, but we're still looking for, when we get here and when we get here, hammer candles. We are looking for double bottoms. We are looking for inverted head and shoulders, right? The whole 9 yards at both of those levels. 185 and 181.50 on a pullback sets up a tighter risk reward trade in the upward direction. If we do continue to close the gap overhead and reach towards that 193, if this gets extended, if there is a tight risk reward setup and you get some sort of inverted hammer up here or an intraday double top, it might be worth taking a stab for an overbought pullback, but please don't overstay your welcome on the short side. Apple is looking definitely more bullish than bearish over the past couple of days. Let's take a look at Netflix. What's going on over here? We did get that move up towards the top of this prior range after breaking out of the multi inside bar setup over here at 436.75. I should round that up to, but you guys know me. If we are above 436.75, I like to round those up. If we're above that, it's bullish consolidation over the cup and handle. We got the breakout, good to go. Watching for consolidation here to set up the next trade. Ideally, a new balance range forms, and we get a break that starts to interact with the gap overhead. That way we can implement tight risk reward principles. To the downside, if we get a break and lower high underneath 436.72, I hope most of you can see it. There's an intraday, like hourly head and shoulders. Maybe we trade back down to the origin of the breakdown, or breakout, excuse me, at 418.75. That would keep Netflix much more neutral, staying inside of this as an overall range. Let's take a look at Tesla. What's going on with Mr. Musk and the rocket ship? We're talking about big time price cuts over in Tesla. I mean, my goodness, ever since we broke out over the 251, it was like, all right, let's see if that turns into an ascending triangle. Let's see if we can catch support at 251, right back down towards the lows. So a little bit of a missed opportunity on my part here for Tesla. I'm trying not to get emotionally involved and say, you missed this, now we've got to like make up for that. So just taking this at face value, we're coming into a retest level where this breakout really stemmed from. Is it reasonable that Tesla could find an area of support here? What was once resistance can now act as support? Certainly. So watching 242.75, if we can find a reversal pattern down here, like a double bottom, great. We'll trade it through the thin structure breakdown, retarget 251 and then 261 over time. If we don't hold that level, it's pretty difficult to short it at this point in time after the big breakdown from the Friday session. So I would wait for a better setup, something that continues underneath, tests a lower high here under 242.75, and then make that rotation to the equal lows at 229.25, trying to, again, manage and regulate the emotions over in Tesla. It's almost like the same concept as what we talked about over in the broad market, right? I would not be surprised if Tesla throws some people for a loop this week. Here's Google. What do we see over at Google? So certainly the opportunity for a head and shoulders, if we find a lower high, ideally, that would want to be underneath 135.85. 135.85 is the level right here. If we continue to stay underneath that, great. You've got your head and shoulders breakdown back into the range. Maybe it's a look above and fail on the daily time frame chart. I would watch for lower highs underneath 133.65 to kick off that move. If we're just trading above, I don't care if it's head and shoulders, right? You know, that's fine. Technically, it's a break and retest over the top of the range here for something that looks more so like this into the future. Really not bearish in Google until we're underneath that neckline at 133.65. It sets up, though, if we stay underneath, let's just call it 136 for round number's sake, right? Bullish trades, obviously, if this produces a higher low, back up to the equal high, breaks there, send you up towards the gap close. 139.36, 140.43 is the close. Metaverse, what's going on with Zuckerberg's Fantasyland? Looking like some pretty decent high and tight consolidation towards the upper portion of the double bottom, trying to get some follow through over 301 for the more constructive look. Obviously, you would want to see a break and higher low intraday over 301, tight risk reward, entry, stop, and target, and that would look pretty decent for a setup there. I'm not saying it has to happen that way into the early stages of this week, but with a balance in place, right, this is what we're waiting for in setups like Apple, basically, where Apple has been a runaway freight train. Meta clearly has the opportunity to leave the range, expand the range, and then move back into some phase of contraction, right? So that's the upside 301. Downside, not really bearish in Meta. Maybe there's a scalp to be had in here back to the breakout point at 290.50, but the bearish rotation really takes place only when you get a lower high underneath that level where this break came from in the first place. 290.50 and 301 are your key Meta levels. Next up is NVIDIA, building out the attempt at a high and tight cup and handle up here, but bear flag consolidation on the Friday session underneath this. There might be the argument to make a nuanced level at, let's call it 490. 425, give or take. But if we're in here, definitely a little bit more bearish breakdowns of 480 with a lower high. I would trade through the thin structure breakdown to the breakout point at 464.78, 75. I got to do some rounding here on my levels, but you guys get the gist. That's the downside trade. Anything that continues to consolidate up here, it's a patience play until this cup and handle can resolve up and into blue sky territories over 502.25. I would not really be thrilled about trying to buy pullbacks here at 480. I think that there's still too much risk in buying at the all-time highs for NVIDIA. You could call me crazy for that, but that's my take on the chart. Here's Microsoft. A little bit of a disappointing breakout up and over the top of this really compressed range here with the gap up on Friday. Was looking for a gap fill reversal. No dice. First time it attempted, right? But really no dice on the follow-through move there. So a little bit back to neutral over on Microsoft. With the failed move out of the range to the upside, I would certainly keep eyes on the downside. If the broad market is pulling back under 326.75, sets up the move for a failed attempt higher to then move lower through the range back to the breakout point, which would be 322 inside of Microsoft. Getting some price acceptance over 329, that's great. Now your upside targets are going to be limited. First by the open of the Friday session at 331.25, and then you've got your 50 SMA in there, and then you've got the overhead level 334.50. You've got this to contend with. So the upside, if it was going to go, Friday was the day for it to go, and the fact that it failed, to me seems as though we might want to keep a very close eye on those lows for a failure to move higher results in the market moving lower, or at least Microsoft to move lower, right? So 326.75 is your inflection point. Last but certainly not least is Amazon, the mini beast, setting up a head and shoulders possibly with a lower high if we stay underneath that Thursday high. Move in there. That's at 138.60. Anything that's underneath that, watch for the breakdown of the neckline through thin structure. That would be underneath 137, which we know is a prior inflection point from back here and also back over here. Failing to hold 137 is a pretty bearish look for Amazon with a big daily lower high or even weekly lower high from here to here, then looking for the equal lows over time. That would be down around 131.50. And if we just go to the daily chart for a brief moment, remember that Google was constructive, building a Lego block in the upward direction. Amazon was not, right? It was back inside of this range. So you're getting much more of a convoluted look from that perspective. Under 137, I do think it has legs to go back towards the midpoint of the entirety of this chop, which once again is kind of right there at 133.75. And one final trade idea for you. This is the moment you've been waiting for, I'm sure. JP Morgan, JPM is the ticker here. This is a bank, of course, and it's looking fairly weak, just like the XLF. It did not participate whatsoever on the rally this week, so relative weakness from that perspective. It continues to remain suppressed underneath the 50 SMA on the daily time frame chart. This is distribution overhead, so there's overhead supply weighing on this ever since the breakdown down here. And if you want to count it as a bear flag, that's fine. A measured move sort of gets you closer to your daily 200 SMA and our reach target, which would be down here where this breakout stemmed from at 139.68. Let's take a look at the hourly time frame chart just to have a closer look. You can see that we've already produced a little bit of a head and shoulders in here, and we got the retest of the neckline on the Friday session. As long as we remain underneath that level, so I would basically look at 147.50, there's your ideal bearish consolidation waiting for the breakdown of 145.75 to get to your first target. There's your 143.32. Then your reach target, as we pointed out, is 139.68. The trade idea is invalidated, not if we come up here. That just becomes less ideal, but it's invalidated if we take out the top of the pattern at 148.75. That would be my primary watch. Other than that, anything in here is ultimately bear flag consolidation. This is ideal bear flag consolidation, waiting for something to do this for trades in the downward direction. If the broad market is pulling back because we've already seen the relative weakness, it would make the most sense that this possibly has some legs in the downward direction. That's going to do it for today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comment section or by simply giving the video a thumbs up. I hope to see all of you live tomorrow morning at 8:15 for our pre-market prep. And with that said, I wish you a green trading week.